In this video, I'm going to define the term commodity, then explain how commodities are traded, shed light on the price, and finally, list some advantages and disadvantages. Definition: commodity is a tangible, everyday good used in commerce that is interchangeable with other items of the same type. In most cases, commodities are inputs of production of greater goods, services. Therefore, they are usually raw materials that are manufactured and then the finished products are sold for money. We can differentiate between two major categories concerning commodities, such as hard and soft commodities. Hard commodities are materials that need to be extracted or mined, such as natural gas, gold, or crude oil. The other category is soft commodities, which are materials that are raised or grown, for instance, coffee, corn, or cotton. How are commodities traded? People also invest in tangible goods, not only in stocks and bonds. They trade in public exchanges and their prices are posted openly. It is possible for exchanges, which is basically a marketplace where commodities are traded, to stabilize in a particular group of commodities or to offer several kinds of commodities at the same time. One of the most significant commodity exchanges is the Chicago Mercantile Exchange, which trades in the sectors of agriculture, energy, stock indices, metal, real estate, and so on. Similarly to stock exchange, performance and value of commodities are tracked by using indexes. The three major indexes used in the United States are the S&P GSCY index, Bloomberg Commodity Index, and the DBYQ Optimum Yield Diversified Commodity Index. Prices of commodities. Commodities are considered to be high-risk investments since their prices are influenced by external elements that usually cannot be predicted, such as natural disasters and weather. As an example, agricultural damage was extensive due to Hurricane Bertha in 1996, which swept through North Carolina. It damaged approximately 60% of the state's crop. As a result of this disaster, the price of this kind of commodity skyrocketed from $2.5 to $4.7 per bushel. On the other hand, their prices are also determined by supply and demand, which is the relationship between the quantity of the commodity provided by the manufacturer and the quantity that the consumers are willing to buy. In addition to these, price of commodities are also influenced by politics and macroeconomics. For example, between 1973 and 1974, crude oil prices rose from $3 to $12 when Arab oil producers imposed an embargo to punish the West as a result of supporting Israel in the Yom Kippur War against Egypt and other Arab nations. Advantages of investing in commodities. As commodities are inputs of production, when inflation goes up, it influences the prices of commodities to go up as well. However, some values are more stable than others since they are not influenced by natural disasters or the weather. Therefore, they are considered a store of value such as gold. Liquidity is another crucial aspect, referring to the fact that commodities are easy to sell and buy as well. For example, online commodity investments can be sold anytime. Commodities play a crucial role in having diversified investment portfolio. A diversified portfolio refers to an ideal asset allocation plan, which means dividing your investments among different assets such as stocks, bonds, and commodities. It is suggested to invest in commodities as well if an investor has already invested in stocks and bonds. Disadvantages of investing in commodities. As it has been mentioned before, the prices of commodities are highly influenced by external elements such as natural disasters and political events, so their extensive volatility is a significant drawback. Another disadvantage is that sometimes there is no income since commodities don't pay dividends or interest. Their return is based on the rise in the price.